It's going to be a short week, but it's going to be a very busy week. Markets close early on Thursday at 1 p.m. for July 4th holiday, and then we'll be closed all day on Friday for July 4th. So we're going to get a lot of data, about 5 days worth of data in 3.5 days. And so that's going to make things a little bit more difficult to parse through, and it might mix signals a little bit. But it's important to be aware of, when these events are happening. So really the important stuff starts on July 1st when we're going to get ISM manufacturing. We're looking for that to come up to 48.8 from 48.5. Prices paid expected to stay at 69 versus 69.4. It's been in the 69 range now for a couple of months. Then also on July 1st at 10 a.m., same time as ISM, we're going to be getting JOLTS, so it's expected to come in at 7.3 million, down from 7.391 million. JOLTS is basically an impossible number for anybody to predict. This number varies greatly month to month. Revisions are awfully pretty big. But generally speaking, the trend has been lower in the JOLTS number. And that really is what matters the most. There are just fewer job openings today than there were a year or 2 years ago, and that's directly because of the Fed tightening cycle. Then on the 2nd, we're going to be getting ADP. We're looking for only 85,000 jobs to have been created. And then on the 3rd, we're going to get a job report. We're looking for only 110,000 jobs to be created, down from last month's reading of 139,000. Now, this has a tendency of, beating on the initial reading, and then when the next month comes out, they revise the next month. They revised last month down. And so it wouldn't be surprising to me to see a beat on the non-farm payroll, only for it to be revised down later. So it's quite possible we get a revision from this 139,000 and see something less than that. Unemployment rate's expected to rise by 4.3%. We'll talk on that in a minute. Average hourly earnings expected to rise by 0.3%, down from 0.4%. Year over year expected to be 3.9%. Work week expected to remain unchanged at 34.3. We're also going to be getting on the same day initial jobless claims. Those are expected to come in at 240,000, up from 236, and continuing claims are expected to fall to 1.956 million, down from 1.74 million. I don't really know which one matters more here or not. Basically, I think the job report will probably trump the continuing claims and initial claims data. So it's just interesting that we're getting them both at the same exact time. I don't really remember a time happening like that before. And then at 10 a.m. on the 3rd, we're going to be getting ISM services. That's expected to increase to 50.5 from 49.9. So there's just a lot of data here to try to unpack in really just 2.5 trading days. And so it's very hard to predict, how the market's going to respond. It is a holiday shortened week. Volumes will be low. Trading desks will be short staffed. So anyone, it's really at this point, anything can go. Obviously, 4th of July week, usually a positive week for stocks. It's generally been the case. You have obviously the effects of volatility being suppressed because it's a shorter week as well. So lots of reasons why the market can certainly rise, but there's also a lot of data coming, and I think that's really the key here. And this is a chart of JOLTS, and believe it or not, you can get all this data on TradingView. You don't need any fancy tools to get any of this data. Most of it is just free data that's out there. You can find it also on the St. Louis Fed website. So all I did here was take the Indeed job posting data and I overlay it with JOLTS, and you can see that basically since May and June, for May and June, we've continued to see the number of job openings coming down. So one would expect that the overall trend in JOLTS, whether this month comes in as expected and comes in lower or not, may not matter, because overall the trend should be lower over time. And if you think about it, if you're getting if the number of job openings are declining, and you're getting the same amount of people filing for unemployment every week, which has been consistently in that 225 to 250,000, well, eventually over time, with fewer jobs available, the continuing claims data is going to start going up. And essentially, over the last couple of weeks, that's exactly what you've seen. Continuing claims have been rising. They rose again last week. Now, we'll see what the data comes in this week. Obviously, it's expected to come down a little bit, and that's certainly possible. But I think what's very clear is that from August 23 until really April of 25, you had been in this range where you traded, or where the continuing claims data came in, between 1.83 million and call it 1.9 million. And that range has clearly been broken now. You could call it a breakout if you want to look at it from a technical sense. Very decisive move as well. So even if we come down a little bit, I think at this point, what this is telling us is that we've now reached a point where the number of job openings is obviously, and the number of people filing for unemployment are now at a point where we're going to start maybe seeing more upward pressure on continuing claims. And continuing claims is a very good over time leading indicator to where the unemployment rate is and where it's likely going. And you can see that right here. This is in purple, the unemployment rate, and in black you have continuing data. And what I'm going to do is just kind of move this scaling a little bit so that we don't get this effect from the pandemic quite as much. And you can see it a little bit more clearly here when you look at the data that over time the continuing claims data clearly leads the unemployment rate by a good couple of months. And so the fact that you're starting to see continuing claims now going higher sort of suggests that we're now at this point where we could actually start seeing the unemployment rate moving up. And the interesting thing is that last month we came in at 7,237,000 unemployed versus 170,510,000 employed, the size of the civilian labor force, and that gave us an unemployment rate of 0.04224. And that's, basically, if you think about it, just about 6/1,000ths off of a rounding to a 0.43%. And so that's really important to make note of, because we were practically there last month and we just barely missed it. And this month we've clearly seen the number of people filing for unemployment increase. The only factor that could come into effect is I noticed last month the civilian labor force fell by 625,000 because the number of people employed fell by 696,000. There's a possibility that this number actually moves back up some next month for June, and that could actually keep the unemployment rate unchanged. It's really going to depend upon how all the numbers kind of come in at the end, but you're very close to that 4.3% number already. And what's important here is that typically, the 10-2 curve trades with the unemployment rate or the expected unemployment rate, and you can clearly see that, the 10-2 curve has obviously moved from about a negative 100 basis points to a positive 50 basis points or so. But clearly, as the yield curve as the unemployment rate rises, as continuing claims rise, we would expect the yield curve really to steepen much more materially than where it is. And now the question, more so becomes, what is that going to look like when it comes time for it to happen? And right now we know that Jay Powell is skating on thin ice with President Trump, and President Trump already told us on Friday that whoever he picks is going to be determined by who wants to lower rates. And so you can see the market's already pricing in a little bit more rate cutting in 2026, with Fed funds now at 3.02. This 3% range has been pretty much a floor in this overall. But what this would what this would tell me is that the current 2-year at call it 3.75 could probably fall quite a bit if we were able to get below this 3.5% mark. Clearly, you could see the 2-year get back to around 3% or so, which would actually only add about another 75 basis points of steepening to the curve, putting us somewhere around 1.25 to 1.3%. And, you can clearly see that the curve in the past has really steepened and moved all the way up to about a 2.6 to 3%. So what this would imply to me is that it's possible you could get a 2-year back to 3%. And you could push the yield curve to somewhere around 1.3%, and then you would tack on another, 1.3% or so to get us up to a 2.6% spread, and that would imply you'd have a 10-year somewhere around 5.6 by the time this process is all said and done. Now, obviously, it's a moving target because we don't know where Fed funds is going to end up. Fed funds could end up at 2%, and if it ends up at 2%, then you're talking about a 2-year at probably around 2% as well, maybe slightly higher. And then you're talking about, a much different picture in terms of the steepening, because you'd have a 2-year that comes down not 75 basis points. You'd have a 2-year that comes down 175 basis points. And if you add 175 basis points where we are currently at 50 basis points, maybe that would mean that the 10-year, instead of being at 5.5%, it would be somewhere around 4.5% or so, assuming a 2-year at 2%. So there's a lot of variability in this and how this is going to play out. But not only does the yield curve steepen when the unemployment rate rises, but the high yield credit spreads widen out as well. And you can clearly see that yield curve steepened, high yield credit spreads went up. This is the ICE B of A high yield option adjusted spread. This is the symbol BAML H0A0HYM2. It's a day delayed, but it doesn't really matter from this perspective. But you can clearly see, in this period of time, that when the unemployment rate continuing claims really started to mount, you already had high yield credit spreads moving up in advance. High yield credit spreads started coming down well in advance of continuing claims coming down. Same thing happened again in 2008, 2009. Came down. Obviously, there were some shocks in here as well regarding, the European debt crisis. This was 2016 when oil was going down pretty dramatically. You saw high yield credit spreads move up because, a lot of these, fracking companies were, at risk of defaulting. And then, of course, you had, with that mini decline in 2018, then, of course, there was a pandemic. And this was when the Fed was raising rates in 2022. So there are things that can move high yield credit spreads outside of economic cycles, but there's a clear relationship that when unemployment rate rises, recession risk rises, credit spreads widen. And that's really important to note, because when credit spreads start to widen, the VIX, implied volatility, starts going up too. So there's no doubt that if we start seeing unemployment rise, if you start seeing the yield curve steepen, you're going to then start seeing, credit spreads widen, you're going to see implied volatility levels in the equity market actually begin to rise as well. So this is all really important stuff, and this is why this job market report on Friday, and even the continuing claims data that comes every week, has become so important, because it's very clear at this point that we're at a point where we could see the unemployment rate kind of move up from here. The question obviously is it go back to does it settle out at just a healthy level at 4.5%, or is it something that's going to be a little bit bigger, that's going to result in a recession? And that's going to take some more time to figure out. But at least as of right now, the data is certainly giving us a sense that, we could certainly see, the unemployment rate rise just based off of what's happening right now over the last couple of weeks. So it's something to keep on top of. Anyway, please remember to subscribe to this channel, like this video, share it with your friends, and we'll see you again during the week. Take care. Bye.